that the Fed is going to have to do more and possibly for longer here. I mean, what were the biggest takeaways for you here into how this does position the Fed and how markets are reacting to it?
Yeah, the Fed still has work to do.
And that they might not hold for some time, and they might not go higher. Well, they're doing all three. That is, they're going higher and they're holding, and I doubt we're going to see much reduction.
It keeps the Fed tighter and higher for longer, which should put downward pressure on those valuations. So it could end up being a bit of a wash for equity market.
Would you have done 50 at the last meeting? Some people, I guess, were arguing for that. Or would you likely do it at the next one? Or would you go slow and steady and wait for more data?
But they put a lot of tightening into the system. So I think I would be 25 basis points the last time and probably 25 basis points at the upcoming meeting, depending on what the incoming data tell us.
Bitcoin is having a phenomenal start to the year, up almost 50% after tanking in 2022. But the equation is getting changed a bit, as many are wondering about the Fed's next move. I mean, after increasing 25 basis points in February, investors were expecting a dovish tenor. Now, as we got the meeting readings, we can clearly see the Fed still has a job to do. Cutting rates are not in the picture at all. So, what will be the Fed's next decision? Are we going to see a hawkish Fed in 2023? If so, how could a hawkish shift by the Federal Reserve weigh on Bitcoin and other cryptos' prices? In this video, Raoul Pal discusses the market volatility, the Fed's rate hikes, and how it's been affecting the economy. To know more details, stay tuned till the end of the video. Also, be sure to subscribe to my channel for more latest videos on the economy, crypto, and market trends. Let's get into the video now.
Raoul, can you just break this down for us? How are you seeing the markets right now?
So I'm a macro guy, so I look at where we are in the macroeconomic cycle and what the markets are forecasting. One thing I note is how utterly negative the market became. Sentiment was an incredible washout. By October, it was, by measurable standards, probably the worst sentiment we'd had in 50 years, which is extraordinary because the market really hadn't gone down a great deal. You know, it was 25, 30%, 38% for the NASDAQ. But when I look at the forward-looking indicators for the business cycle, they're all looking for a big recession that's coming, or certainly a short, sharp recession. But many of the indicators are starting to look up, and we're starting to see liquidity come back into the markets. It started within China, but it's coming elsewhere too. And I think the markets are picking that up. And that's what we're seeing, which is this rally that is the most hated rally I've seen in a while. People like, it's got to go down, earnings need to get marked down. And my thought process, this is actually closer to 2018-19, when the Fed eventually stopped raising rates and the market took off. And it didn't really look back for the whole next year and a half until COVID. So I'm actually very constructive on markets overall. And I think I'm very comfortable in the fact that most people are very negative. I understand, however, that there's risks to my view. You know, something could mean that the economy is weaker for longer or liquidity doesn't come back. And that's a risk there. But the balance of probabilities are, to me, that things are probably stronger than expected.
Raoul Pal is a macro guy, and he looks at the bigger picture. For him, this crypto rally doesn't seem like the start of a bull cycle. The Bitcoin rebound has been particularly extraordinary. We can all agree to that. Bitcoin was on track for its best January and February since 2013, as the prospect of slower rate hikes from the Federal Reserve increased the risk appetite among investors. But the equation seems to have changed a bit now. The rally seems driven by the belief that the Federal Reserve will ease back further on aggressive rate hikes. But it's not all rosy for crypto this year. Subsequent data releases have resulted in an expected shift in tone to hawkish once again. And a hawkish shift by the Federal Reserve could weigh on Bitcoin and other crypto prices. While the broader market cues have been switching between bullish and bearish, no single direction can be suggested at the moment. However, if the FOMC minutes reveal a consideration of a larger interest rate hike, analysts are expecting a dip in Bitcoin price. Raoul Pal also noted that the probability of the economy entering a recession in 2023 remains elevated as well. Crypto prices ended the day lower as markets expected the rate to remain higher for longer. As a result, a damaging effect on the economy is expected over time.
There's a disconnect, at least for me, between what the market is seeing and what Powell is saying. I'm wondering how you think that gets resolved.
So I think it's rate of change that matters the most. And the Fed is signaling, you know what, we're pretty close to an end. 25 after the 50s is already a rate of change decrease of 50%. And soon we're going to get a pause and wait and see, which is exactly what happened in 2018, end of December 2018. It's the rate of change of the rate increases that really matters, because the rates of changes are like you're holding the beach ball underwater. You take your hand off the beach ball and it pops up, and stimulus is whether you get a gust of wind beneath it. So I think that regardless of what Powell says, even if he keeps rates higher for longer, I don't think it's the level of rates that's the biggest problem. It's the rate of change of people having to deal with it that's the problem. And I think that's what caught the market by surprise, because this was the fastest change of rates in all history. The rate of change to the new norm, possibly, but it's so difficult to tell because we've gone through this pandemic. Is this all a whipsaw? When I put a log chart of 10-year yields up since 1980, we get this huge spike down in the pandemic and then a huge counteracting spike up. And it's like, well, maybe it's just a whipsaw. And I think it's really difficult to know. Liquidity's certainly not there, but liquidity in the markets is a function of financial liquidity, and financial liquidity is highly restrictive. So I think that's somewhat of a problem for people to try and figure out, okay, what have we got? There's a lot of, and I hate using the expression cash on the sidelines, but there's a lot of people out of the market. And so it tends to get a bit squeezy. The other thing that's changing the structure of markets that you alluded to is the sheer amount of option activity. I mean, we've never seen anything like that before.
Powell has bent over backwards trying to hammer home that he's going to hike and he's going to keep rates longer. I mean, inflation has been slowing from the 40-year high of 9.1% annualized rate reached last year. Annual inflation in December came in at 6.5%, down from 7.7% seen in November of 2023. But it's still way above the Fed's 2% target. On February 1st, the Federal Reserve raised its benchmark interest rate by 0.25%. On February 14th, the U.S. CPI data for January showed that inflation had moderated slightly. Annual inflation fell to 6.4% in January, down from 6.5% in December. While the January 31st to February 1st meeting ended with a smaller rate hike than most expected, officials stressed that inflation is a major concern. The FOMC members were in agreement that they continued to anticipate further rate increases. Let's get into the next clip to hear more from Raoul Pal. But before going ahead, be sure to give a big thumbs up to this video.
The market has learned something new, and something new is that there is a form of stimulus, which is quantitative easing, that in a low rate environment tends to get used. Now, rates are up much higher now, so maybe rates have to come down further first. The market's still yet trying to decide where we are with the interest rate cycle. Was the rise in rates an aberration and inflation is still subdued at underlying level, or has something structurally changed? And these big questions are the kind of things the markets are grappling with. They don't really know, but markets themselves have become much more forward-looking in terms of stimulus. So I think this is why things pick up much faster and fall much faster depending on the rate of change of what's happening with stimulus. So it is a very interesting junction. My hypothesis is that inflation itself probably ends up negative by late summer this year. And again, we'll be looking at some sort of stimulus cycle. So let's see.
It's hard to really wrap your head around what exactly this is all going to look like in the coming quarters. And that's why I think there are so many different opinions out there about exactly what we are seeing right now. So what do you guys think? How long will it take for inflation to fall back into the Fed's target? Are we going to see a hawkish Fed in 2023? Will Bitcoin price fall back in the coming months? Let me know your thoughts in the comments below. For more videos on the economy, crypto, and market trends, be sure to subscribe to my channel. You can also hit that bell icon to never miss any video. Also, be sure to like and share. I'll see you guys in my next video. Adios, and thanks for watching.